This is the current federal tax developments for February the 11th, 2019. Current federal tax developments are brought to you by Kaplan Professional Education and your state society of CPAs. This week, we're going to take a look at 4 different situations that have come up in taxes. I'm going to start out with an IRS letter that discusses situations when an employer is able to recover HSA funds from employee accounts. The IRS issues a chief counsel advice that indicates that taxpayers can use Revenue Procedure 2018-60 even if they're currently using an impermissible method of accounting for revenue. In the third case, we're going to look at taxpayers who we discover how they can reasonably rely upon the advice of a tax professional, even when that advice turns out to be not what the court believes should have happened. And finally, we'll take a look at an unfortunate airline passenger who went after the wrong agency for his lost tax refund. And we'll discover, the overriding rule in the federal law of having to pursue tax refunds, any claim that might arguably be a tax refund, first with the taxing agency. Well, I thought I should remind everybody this week, so you don't forget, that this is the week that Valentine's week is coming up, right? Remember, the 14th of February is coming up this week. So if you've forgotten about that little detail, it might be a good time to take care of it about right now. Otherwise, hey, Valentine's Day also means, unfortunately, when you're in tax, that you're really starting to get to the real time where tax season ramps up all the way. The brokerage accounts, the brokerage 1099s will be coming out right after Valentine's Day. Remember, the 15th of February is when they're supposed to issue those things. So by this time next week, actually, probably most of us will be buried, however deep, in tax returns, with the individual returns now starting to come in just as quickly as everything else. With that, let's start with this week's first development. This, we're going to take a look at an IRS Information Letter, Information Letter 2018-033, that was issued on February the 4th. And it deals with a situation that arises asking about if you're an employer and you've established, you're funding HSAs for your employees. You've decided you're going to do some of the funding. You're doing it maybe through a cafeteria plan. You're doing it maybe directly as an employer. When can you reach back in? Now, a mistake's made. Turns out the wrong amount goes to an employee's account for the HSA. Can we reach back in and get that money out, or are we out of luck? And this can be fairly significant because, remember, we're talking about HSA fundings and the excise tax. There is an excise tax that's imposed on the employer if they don't make equivalent contributions to all covered employees. That meant that if extra money got into one employee's account and we don't fix it, in the extreme case of the service pushing the issue, and it is the way that the rules read, the IRS would be able to come back in and get 35% of all the money we put in everybody's account as a penalty to the employer for having overfunded the one employee by $10. So the employer's other option there would be to try to jump funding everybody else to make up for the $10 overfunding on the one. Obviously, not necessarily the best result if an error is made and errors are made. The IRS had issued Notice 2008-59 a few years ago, basically a decade ago. And that notice outlines situations where an employer would be allowed to reach in and grab money from an account. And it talks about a series of questions and answers in that notice. And that Q&A discusses situations when an employer is going to be allowed to reach in, even though the HSA account is non-forfeitable for the employee. It's supposed to be the employees. You can't touch the money once it's in there. They're saying, yes, you can have an agreement with the bank or whoever's holding the account, that in certain situations where there's been an administrative error, you'd be allowed to go back in and take the funds back out. But 2008-59 only talks about certain situations. And obviously, people get concerned, well, what about situations outside of that? And this letter, which is just an information letter, that's one caveat we must make with this Information Letter 2018-0033, you have to understand it's not totally binding on the service, but it is probably going to be considered something that they're going to follow. They would end up with problems if people are relying on this letter and the IRS goes back on it. It is published on their website. So what it tells us is that the notice does not specifically address other situations where the HSAs are the result of the employer's or trustee's administrative or process errors, But the notice was also not intended to provide an exclusive list of circumstances under which an employer may request the return of contributed amounts. The goes on to note, if there is clear documentary evidence demonstrating there was an administrative process error, an employer may request the financial institution return the amounts to the employer with any correction, putting the parties in the same position they would have been had the error not occurred. In such cases, they warn you, the employer should maintain documentation to support their assertion that a mistaken contribution occurred. I don't know if this is going to give kind of the level of assurance, or let's say the level of comfort that those that wrote for guidance were looking for, but they did go on to list specific situations where recovery of funds would be appropriate. The ones they list, let's go down that list. They tell us basically that you could do this if you have an account withheld and you deposit money in an employee's HSA for a pay period that's greater than the amount shown on the employee's HSA salary deduction election. Secondly, an amount that an employee receives as an employer contribution that the employer did not intend to contribute, but was transmitted because an incorrect spreadsheet is accessed or because employees with similar names are confused with each other. So you meant to put $500 in one person's account. It ends up in another person's account because they have similar names. You ended up making a mistake transmitting a spreadsheet. I'm not sure how spreadsheets got involved with wrong spreadsheets, but obviously somebody had that issue. And those are fine. Third, they say an amount that an employee receives as an HSA contribution because it's incorrectly entered by a payroll administrator, whether in-house or third party, causing the incorrect amount to be withheld and contributed. You had a typo. You have a date entry error. That's okay. An amount an employee receives as the second HSA contribution because duplicate payroll files are transmitted. Yeah, that sometimes happens, and okay, we can solve that. An amount an employee receives as an HSA contribution because a change in employee payroll elections is not processed timely, so the amount withheld and contributed are greater than or less than the employee elected. Actually, less than is probably less of a problem for us. We could always make that up. The question is, can we get the excess out? An amount that an employee receives because an HSA contribution amount is calculated incorrectly, such as a case in which the employee elects a total amount for the year that is allocated by the system over an incorrect number of pay periods. So you were paid bi-weekly, you didn't really check to see for sure how many paydays would come up this year, and you divided by the wrong number. Then we can correct those. Finally, an amount that an employee receives an HSA contribution because the decimal position is set incorrectly, that could be embarrassing, resulting in a contribution greater than intended. Yeah, moving a decimal point, getting a multiplier of 10, that could be a problem, could be fairly significant. All of those cases this letter suggests, these are examples of the types of errors that under Notice 2008-59, even though that notice does not talk about these specific errors, these specific issues, errors like that, pure obvious administrative errors, you're allowed to reach in and grab the excess contribution out. Again, don't know if everybody's going to be happy with this list. I think people like really, really bright lines and cases where they tell them exactly what it'll be. I think the IRS position here is there's no way to do a bright line for every administrative error that could occur. If it's purely an admin error, they're saying, look, financial institution, employers, it's okay to reach in and take it. Next, let's go on to a little bit different view of a problem. And this is a case that's addressed by Chief Counsel Advice 2018-52019. It was issued on February the 1st of 2019. And this relates to Revenue Procedure 2018-60. Revenue Proc 2018-60 was issued by the IRS to allow the taxpayers to obtain consent to change their method of accounting to meet the requirements under Tax Cuts and Jobs Act of 451B1A, which provides that you have to recognize revenue at least as quickly as you do on your Apple financial statement if you are subject to the all events test, your accrual basis all events test. All events will be deemed to be satisfied on the date when the income is reported on the Apple financial statement, even if it's not otherwise yet met the all events test. So basically, report your income at least as fast as on the financial statement. And this gave us an automatic method change. So we do a 3115. We're able to catch up this year. We have our automatic method change. and all is well with the world. Except in the case in question, the taxpayer had been using a method previously that was inappropriate. They had not been properly applying the all events test to when they had recognized revenue for tax return purposes. Now the question becomes, can that taxpayer use this revenue proc in order to adopt 451B's new rule and correct their currently erroneous method of reporting? So what they wanted to do was have this automatically changed under 2018-60. And obviously the question came up and said, well, is that possible? Or will they need to file one change of accounting method that would cover those situations where we're going in it when we have an inappropriate method? We're going to switch to an appropriate method under all events test, but that appropriate method will cause the revenue to be recognized either earlier or at the same time as it would be in our financial statements. So that we're not really, 451's not causing the change. What's causing the change is we had our accounting method wrong to begin with. Well, the IRS looked at the actual notice. They looked at the actual Rev Proc. And the Chief Counsel advice concludes in the memorandum that, in fact, the memorandum refers to a situation where a taxpayer changes to apply the all events test, with the caveat as required in the code, with the caveat that they have to accelerate that recognition event under 451B if the Apple financial statements recognizes earlier. The memorandum includes that implicit in a change to Rev Proc 2018-60's method of accounting is that you are going to be using the all events test for your recording income properly, and that proper application now under 451B1A will include this acceleration clause. In order to do that, of course, it's going to automatically cause your other revenue to come in at the proper time. So they said, because in fact the memorandum did not say you had to be using a proper method to start with, you just will decide to meet the all events test, whether it is the traditional all events test or the one more rapid recognition of income, and that taxpayer who had been doing an erroneous method. And again, we don't know if they've been recognizing revenue too quickly, had they been recognizing revenue, basically too late, too slowly, but they can fix that all with 3115 by opting for 2018-60 on this year's return. That's a taxpayer-friendly interpretation. I think the catch here is the IRS really didn't want to get, because conceivably there might not have been an automatic change to fix the old method, so they would have had to have a non-automatic change for that, automatic change for 2018-60, for 451. No, just go fix everything right now. We're done with it. We don't really want to mess with having to go through something else. Next up, this is one of those cases where we're going to look at a taxpayer who received advice, and when we got to tax court, it turns out that the court did not agree with the advice given. This is the case of Doyle versus Commissioner, Tax Court Memorandum Decision 2019-8. It was issued on February 7th of 2019. Mr. Doyle had been working and had been a well-paid individual working in the upper levels of Wacom. Got to get the right name. I'm thinking Wacom, yes, the name of it. So he'd been working with Wacom, the people that do the pins and tablets. And what he discovered was, he got into a dispute with his employer regarding some activities. He felt he was basically dismissed for reasons that he was looking maybe to be a whistleblower, troublemaker, whatever. He went and filed a claim and threatened to file suit against his employer. And part of his allegations eventually became that he suffered emotional distress. His employer signed an agreement and paid him funds, and the employer signed the agreement that he signed, which was reviewed by his attorney, and which he signed, which is part of negotiations, provided that the payments from the employer were for his emotional distress, having been let go. Now, you point out, of course, this emotional distress involved some, both physical, the emotional anguish of being let go as an employer and the stress level caused him various physical ailments as well. So he tried to argue he could exclude it from income. The court pointed out that this has been litigated before, and that in fact, the courts have held that even though this emotional distress may eventually lead to some physical manifestations, those physical manifestations are part of the problem called emotional distress, and emotional distress has been, excluded from coverage under 104A2. So hey, so he's got a nice big chunk of change due in tax. Now the question becomes, does he owe a penalty? Well, his chunk of change owed was way beyond the limitations for a significant understatement of tax under 6662. Whenever we have that significant understatement of tax under 6662, which is generally the excess of $5,000 or 10% of what should have been shown on the return. So for instance, a taxpayer had a return that had $95,000 shown as total taxes for the year. IRS does an exam. They determine that in fact there should have been an additional $20,000 of tax. That gives us up to $115,000. $20,000 is significantly more than 10% of $115,000. And so automatically a $4,000 penalty comes into play. There are only a couple of ways to get rid of that penalty. The only burden on the service is to show that mechanically, the amount of the assessment that they carry in the court, tax court, or you agree to, meets that $5,000 10% test. The two ways out. Number one, we could show that our position had substantial authority. Well, in this case, that's not true. There were a number of court cases. As the court said, this has pretty much been decided. The law's relatively clear, and there really wasn't much of an argument in favor of this, once you looked at that background. So the court said, okay, that's, we're not even going to try that argument. The second way is you could have disclosed your position, and if there is a reasonable basis for the position, then we get out of the penalty. Well, you disclose the Form A275 generally. And the good news is almost always that works to get rid of the penalty. The bad news is, as is also almost always true, the taxpayer didn't file the form. So now we got a problem. We're there. There is a third out. If the taxpayer can show reasonable cause for the understatement, then the taxpayer can escape the penalty. Now, reasonable cause pretty much comes down to showing that the taxpayer took reasonable efforts to properly determine the tax that was due. And despite those reasonable efforts, and we're going to consider the taxpayer's skill level, their knowledge, what they did they nevertheless end up with this underpayment? One of the ways you can show that is by showing reasonable reliance on the advice of a third party. And so the taxpayers here were looking at that issue. In this case, they had prepared the return, had been prepared by their longtime CPA, who prepared the return every year. The question is, was it reasonable to rely on this CPA? And did they actually reasonably rely on his advice? And did they seek the advice? Well, to cover this, we really have three tests, and the court goes through all three. The first test we look at is, okay, you knew that this was over your head. And hey, that's important. The taxpayers realize it's a complicated area. It's involved. I'm not a tax expert. I need to try to, do some work. I just don't know this off the top of my head. How can I discover the answer to this question? And because this is obviously a complex issue, and if you look at any detail, you're going to discover quickly that this is messy under 104A2. So the taxpayers look to find an expert. The expert they found was a CPA. And again, it's a long-time person been preparing the returns. And this particular CPA was somebody who was, looks on paper for an average person trying to figure out to have a qualified person, looked very qualified. He was an Ivy League educated CPA, right? Not a ton of those. So that looks pretty good. He had over 40 years of experience preparing returns. Okay, been around quite a while, Ivy League education. He'd done theirs returns for a decade. He knew their stuff inside and out, right? He's licensed to practice in 4 states. He teaches college accounting practice. And, he's given them the impression that he's keeping up with federal tax laws. As the court said, that fact pattern, even if the Noyles were knowledgeable about tax law, which it points out they're not, the court still would have found that Hunter seemed competent, he was the CPA in question, to justify their reliance. So, perfectly, competent CPA, had the background, he's the guy, we can work with him. So we sought competent advice. Now, that does you no good. You've got a competent professional, but if you don't give them the information they need, or you keep information from them, that's going to hurt you. Well, the CPA testified that he'd reviewed the entire documents. He reviewed the settlement agreements, he reviewed other documents about the agreements. All those things were involved. Now, the Doyles didn't bring those documents to the court, but they brought the CPA to court. The CPA said, yes, I was given all information that I needed. And for those of us in practice, we understand that since we understand the case better, sometimes that means we're going to need to ask clients, and we will ask clients for things that they didn't necessarily bring. But everything was provided. This CPA felt there was nothing he was not given that would have, had an impact on this advice. So he meets the second prong of the test. So we have an experienced, capable CPA. He was given all the information necessary to give advice on this issue. Now, the final thing they've got to show is that they reasonably relied on that advice. And there was a problem here, but the Doyles got out of it. Turns out the taxpayer, and unfortunately, this is something a lot of our clients would do too, and it hurts. It's not something that's good to admit if you want to win this issue. He admitted that when Mr. Doyle was presented with a return by the CPA, that what he did, admittedly was, he said, like most people, you look at the bottom line, see how much you have to pay or how much you're getting back. And that was all he really worried about. He signed the return. He implicitly trusted the CPA to have prepared it right. This particular admission has caused problems in some cases in the past. It's an issue. There is a responsibility for the taxpayer to review the return. Now, I think here two things are of importance. First thing is, and we don't say it in the court case, but I think it's clear, implicitly, the taxpayer in this case knew the issue of how this should be taxed was a problem. Implicitly, they knew they had asked Mr. Doyle, not Mr. Doyle, Mr. Doyle had asked the CPA to look at that information. And so their assumption was it was covered in the documents in here, and it must have been covered properly. Where this kind of I didn't review the return becomes a big problem is, let's say the CPA made a mistake. It was not a mistake of interpreting the law. It's just a mistake of left off a major, like say, major distribution from retirement plan was left off the return entirely. It's not there. That's where it's more of a problem. They didn't review the return. Because in that case, they have definitely held in that case, you blew your chance to say reasonable reliance. But in this case, they said, well, basically, because of all the facts surrounding this, even though they admitted they didn't review the return in detail, we're still okay that they relied upon it. They didn't even say they had reviewed those sections about how he reported this, and he did report a little bit unusually, as you'd find out if you read the case. But even though they didn't review that, the court said, we're still okay with that. So because of that, reasonable reliance on a CPA. Yes, the advice you gave was not the advice that was substantial authority. No, you weren't told to disclose it. So yeah, there's a problem with the advice in that realm, but your reliance on it, totally reasonable. And because of that, no penalty will be imposed on you in this situation. Next up, and finally, this is just kind of an interesting case. Interesting to me because I go around doing a lot of these CPE courses. I'm on planes quite a bit. Was on a plane this last week, coming to and from Palo Alto, California. And this case just gets me because of the nature of it. It does involve travel and taxes. Schleicher versus U.S. Transportation Security Administration. The IRS isn't involved in this case, which it turns out was a problem, but they're not. This comes from a U.S. District Court in Colorado. It's case number 1:17 CV 01284. The opinion was issued on February the 7th. In this particular case, the taxpayer had decided to check luggage at the airport. Okay. Now, we all know, great fun. You do that, goes up to the counter, checks the bag, it goes away. And eventually, of course, it's going to be scanned by the Transportation Security Administration, the TSA. Well, turns out some of that luggage, as we know, is picked for review by TSA. They inspect it if they see something unusual, if they have any other reasons. And in some cases, they just randomly pick them to look at. I've had that fun a couple of times. I have pre-check, and if you have pre-check, every so often when you walk through the little scanner, they suddenly it beeps at you, not because they got any metal detect on you, but because they want you to have now enhanced, enhanced review of you for this case, and then you get to do a lot more fun stuff. Because of that, this was the same thing. So a suitcase gets pulled. So he gets back, he gets home. He had flown from Phoenix to Denver. And being a Colorado case, going to assume he lives in the Denver area. So he had checked his suitcase in at Sky Harbor, the airport here in Phoenix. And the TSA had looked at his stuff, respected it. And whenever that happens, you get this little note inside your suitcase that the TSA looked at your stuff. But here was the problem. Inside that suitcase was basically multiple files, folders, and paperwork is what the complaint said that related to Mr. Schleicher's taxes for 2015. Now, this was February of 16. Because that just went missing, it didn't get repacked. He's assuming, the assumption is that when the TSA took all of his stuff out of the suitcase, took out, everything you need to take there, see what the problem was. When they repacked it, they didn't manage to pick up those folders and papers and put them into his suitcase. As such, they're missing now. He doesn't have them. Not having them, he said, he was unable to have the documentation necessary that would have allowed him to obtain a $5,000 refund from the IRS. He is now suing the TSA basically because, of course, if they do manage to misplace, lose stuff that comes in your suitcase during the inspection, there is liability there. There's a claims process. He filed for it. The TSA denied his claim. He then went to court. Under federal law, you're allowed to, if the TSA denies your claim in a situation like this, you are allowed to take them to district court. He took them to district court, Schleicher versus TSA. But the government said, no. See, this isn't really suing the TSA for lost documents or for the value of lost documents. This is really a claim for a tax refund. And what the court found was, claims for tax refunds under Section 7422 of the Code. You cannot, no suit or proceeding can be filed against the government for a tax refund until you have pursued your administrative remedies, which means he should have filed a claim for refund with the IRS and waited for the IRS to accept or reject that refund. And only after they rejected the refund could he then file suit, because this would be a tax refund case. This would not be a TSA lost luggage case. Well, he said, no, I'm asking for lost luggage. Well, the district court in Colorado agreed with the government that this was a refund case. And what the court came down to, they said, look, there are three key things that tell us this is a refund case. They point out first that the U.S. Supreme Court in Clintwood Elkhorn mining case from 2008 had ruled that basically if a case involves a claim for refund, even if it involves something else, their claim against federal government. But this particular section, 7422A, it has, as Chief Justice Robert points out, 5 innies in one sentence, and it begins to seem that Congress meant the statute to have expansive reach. It says any refund case, absolutely. And as Justice Roberts points out, it 5 times says any. So this is a refund case. And the court said, yep, look, the taxpayer, or this case, the traveler, I want to say taxpayer because I usually do that when the IRS is involved. Let's say traveler. The traveler in this case was asking for damages exactly equal to the amount of his estimated lost income tax refunds. The way he was proving damages was going for lost refund. He made no claim the documents had any value aside from helping him claim that tax refund. And finally, he didn't claim the TSA failed to repack anything else. So it was solely a claim to an inability to claim federal tax refund. Interesting enough, the judge did say in that case, or the magistrate, I should say, did say in this case, that If there had been other property, the answer may very well have been different. If it was other property and this refund, then the whole thing might have been litigated under the TSA, under the statute that deals with TSA lost items. But in this case, it's entirely a tax case. So the taxpayer said the plaintiff, in substance if not in form, seeks a $5,000 tax refund. And because of that, he absolutely has to go through the administrative claim procedures of the IRS and allow the government to give him his tax refund or deny it. And then if the government denies his refund, then and only then could he attempt to file a claim, could he attempt to come to court and try to get that refund paid. Well, yeah, it's like I said, the 14th is coming up, the 15th. By the 15th of February, we're starting to release 1099 consolidated 1099s, and everything's running. So this is our last chance to get some State Society 199 Cap A updates. And I'm actually lecturing on, February 11th, but that's the date a lot of you will be hearing this in Arizona regarding this update. But if you hear it before then, you can still register as long as you get in before Monday morning. But I'm going to presume a lot of you that's too late. We do still have one more option for you to get a 199 Cap A update. I will be doing a 4-hour webcast. It will be at the Idaho Society of CPAs on their website, www.idcpa.org. It's a 4-hour session. It's not a repeat. We're not rebroadcasting. We're actually going to give the session again, so it will be a totally live session, but it is going to cover exactly what was covered on the earlier session back in January. So if you took that session and you take this session, you're not going to get CP credit for both. Okay, basically, I'll put it this way. I don't know of any state society to give you CP, or any state society, any state board that's going to give you CP credit for both of them. But if you are still looking, I mean, we're running out of time. If you have not had your 199 Cap A updates, you can get this one again, 4 hours, February 13th. If you're a member of the Idaho Society of CPAs, obviously you get a discount as a member. It comes up 9 a.m. on Wednesday, 9 a.m. Mountain Standard Time. So if you want to sign up now. After that, this is my last session before we, finishing up before we get out of tax season. So again, last chance for 199 Cap A updates. There are still, I think, the New Jersey Society is going to have some 1-hour updates or 1.5-hour updates coming up later on. But yeah, we're pretty much getting to the end of this. So if you want to have an update, this is your chance. As always, you can catch our regular weekly update information. You can catch it online on the website, currentfederaltaxdevelopments.com. If you have any questions or comments, you can send them to me, edzollers@currentfederaltaxdevelopments.com. You can follow me on Twitter. On Twitter, my address is @edzollers. You can also follow discussions on me. I do, as I've mentioned previously, I follow the Connect sites for the Arizona, New Jersey, and Minnesota Society of CPAs. I also follow somewhat Cal CPA's Tax Talk. I'll check in there from time to time. And I do follow discussions. I'll drop into the Tax Pros discussion group on Reddit/r/TaxPros there. Again, got any issues, you can check one of those resources. And if you want to have a discussion, we can. The Twitter part's interesting because on Twitter, there are a number of us that bounce around various tax issues, and a lot of discussions of 199 Cap A, and now discussions somewhat on 163J are starting to run there. Again, with Twitter, they're very short. We have short discussions, short topics, and very focused. It does help because we focus on a very narrow issue, specific issues in those cases, because you can't really do a 3,000 word essay is not what's going to work there. So you might check out there, and if you've not checked, take a look. Either one of those. Otherwise, we'll be looking for you next week. Hopefully you take care of the Valentine issue this week. And we'll be looking at you next week when we'll be into now the real running of tax season. And we'll take a look at what comes out in the following week in the area of federal taxes. So take care, have a good week, and we'll see you next week.